I'm Philip Chandler. I'm the lead fund manager for the Schroders Stakeholder Fund, and I head our UK multi-asset team here at Schroders. It's January 2025, so the first thing I want to do is take stock of where we are today. Equity markets, so stocks and shares, delivered strong returns for investors last year. And that's particularly true of US equities, where for UK investors, they made a return of 26% last year in sterling terms, a fantastic result. Outside the US, returns were positive, although not quite as strong, ranging from 2% in Europe to 10% in Japan, once again in sterling terms, so what you would have received as a UK investor. The US outperformance was driven by two factors, as I've discussed before. First, what the market has termed US exceptionalism, stronger economic growth in the US than we've seen here in the UK or in Europe. And secondly, the dominance of big tech companies in the US, in the AI theme, Nvidia, Microsoft, Google and Meta, have all soared as investors bet that AI will be highly profitable. On the fixed income side, performance has been much tougher, with global government and corporate bond markets posting returns more in the order of 2 to 3%. Robust US growth has been great for company profitability, but it's stoked fears of higher inflation, which means that central banks likely won't reduce interest rates by as much as investors had hoped at the beginning of last year. Put it all together, and the Schroders Stakeholder Fund had a good year, with total returns in the order of 9.5% for the managed one fund. So well in excess of what you might have earned in a typical bank savings account, and also well ahead of inflation here in the UK. And that's after a strong 2023 as well. So over the past 2 years, the Schroders Stakeholder Fund is up 19% for the managed one fund. So what's the outlook going forwards? Well, some of the same positive themes continue, but there are some differences. Last year, if you'd watched my videos, you'd have seen what was essentially a very simplistic message not to overthink things. Economic growth was good, which was great for company profitability, and inflation was falling, leading to central banks reducing interest rates. This was supportive for equity markets. Both of these factors still hold today, but there are two risks which worry us. First, are we moving into a world of higher bond yields? During the 2010s, many governments were running tight fiscal policy. Think of the austerity that we had here in the UK. As governments retrenched, so central banks like the Bank of England reduced interest rates to counteract this tight fiscal policy. But the pendulum seems to have swung to the other side in many countries in response to populist demands. Many people haven't seen an improvement in their real standard of living for the last 15 years, and they're demanding that governments do something about it. As governments continue to spend more on healthcare, defence, investment to generate stronger growth, so they're having to borrow more. The ultimate constraint on populist fiscal policies will likely be their consequences for inflation and debt levels, and the willingness of bondholders to accept both of these. Higher government spending today may be storing up problems for markets in the future. And the key thing is, how much higher will bond yields go? Much higher than today, and they could slow the economy and start to undermine the relative attractiveness of equities. The second challenge is the concentration of stock markets. Think of the large tech stocks in the US or luxury goods and some healthcare names in Europe. To be clear, this has been justified to date. For example, it's those big tech stocks like Nvidia, Microsoft and Google that have been amongst the most profitable companies. They've delivered the proverbial goods. But when a small handful of stocks dominate stock markets, it means the returns are less diversified. Investors become exposed to idiosyncratic risks at each of these large companies. And some investors who have relied on previous winners are now starting to miss out as other sectors have started to perform better. If you look at these two challenges, higher bond yields, lower diversification in stock markets, then it becomes clear to see why changing political forces are important. I could have spent this whole video talking about Donald Trump and what he's likely to do after his inauguration, but I thought it more important to talk about these two big challenges for markets as then it becomes clear why the changing political consensus is so important. Will Trump, but also other governments here in the UK and in Europe, rein in spending? Will they announce policies that are particularly favourable or bad for some of these big companies? Our view today is that equity markets, so stocks and shares, seem likely to remain the best asset class for this year. And certainly that's how we've positioned the Foresters Stakeholder Fund today, with higher allocations to equities than we would normally have. On the bond side, we're sitting on the sidelines today, waiting to see what Trump and other governments will do. But we are cognizant of the risks to our equity positions and thus ready to move to protect portfolios if necessary. So the story is the same as last quarter. We remain cautiously optimistic. But it's important to remember that investing carries some level of risk. Our goal is to aim to protect your investments from economic downs while taking advantage of opportunities when they come up. We're here to help you navigate the investment market. Thanks for watching.